Hi, this is Beatrix Whipple, and today I'm going to go over the latest version of the residential purchase agreement, otherwise known as the offer paperwork. It's a lot of paperwork. There are some things that are very important. There are some things that are not so important. I'll go over all of the main points and go over more quickly some of the less important things. A lot of this is generic. It doesn't necessarily have any impact specifically on the property that you're purchasing. They're just general disclosures. So let me go over these. I'll point out all of the important facts, and I'll also email you a blank copy of this so you can look through it and reach out to me with any questions. Okay, so the first page of the offer is an addendum called the Disclosure Regarding Real Estate Agency Relationship. This just says, hey, everyone is aware that there's an agency relationship here. I am representing you as a buyer in this transaction. I hang my license with Avenue 8, which is the broker that I hang my license with. Here is buyer 1's name. If there are two buyers, buyer number 2's name goes over here. And then here is my name, Beatrix Whipple with Avenue 8 is representing this buyer. It also says I have a fiduciary duty to you. I have to represent your best interest, disclose anything I know about the property, just really setting clear guidelines of, hey, I am representing you in this transaction. 2 pages of this. The next page is the Fair Housing and Discrimination Advisory, which is a generic disclosure that both buyer and seller have to sign that says it's illegal for a seller to discriminate on any basis of race, sex, marital status, citizenship, color, sexual orientation, familial status, ancestry, gender, every single thing in this box. Just a very generic disclosure that both buyer and seller sign, agreeing that they acknowledge that it's illegal to discriminate on any of these items. Okay, possible representation of more than one buyer or seller. This always means at least one thing. Sometimes it can mean 2 things. So multiple buyers. What this means is that, and this is one that is always the case, that the broker, Avenue 8, who I hang my license with, has more than just you as a client. There are other buyers represented by other agents or other buyers represented by me who are also looking for other properties. It does not mean that I have multiple buyers offering on the same property. It just means that you understand that Avenue 8, who I hang my license with, has more than just you as a buyer. Dual agency, sometimes it means this. Dual agency would be a case where I have a seller who is either listing their property or wants to list their property, and you are potentially interested in that property and may make an offer on it through me. Sometimes this happens like if I have a listing and I'm holding open house and I meet people and they don't have an agent that they're working with and they decide to work with me and put in an offer through me on that property. Dual agency. The only time that is ever the case is if both parties, buyer and seller, are completely aware that I would be representing the seller and the buyer in this transaction and are comfortable with that. This would never be a surprise or an unknown. So to recap, it always means that the broker has multiple buyers. It sometimes means that there's a dual agency situation going on. And if that's the case, everyone would be well aware of it far before signing any documentation. Wire fraud and electronic funds transfer advisory. This is a generic disclosure telling the buyer to, when they wire money, which you'll wire to escrow when your offer gets accepted and when you're closing the transaction, to know who you're wiring money to. There's a lot of wire fraud out there. Make sure that when you wire your money, you're wiring it to the correct entity. Okay? Now, this is the first page of the purchase agreement. So a lot of things are listed out here. These are the most important terms on here because it identifies the buyer's name, the property address, the assessor's parcel number for the property, which is right here. That's the tax ID of the property, who's representing the seller, who's representing the buyer. And then over here and under section 3, these are the terms of the offer. So in this fictitious offer, there's an $800,000 property that's being, the purchase offer is $800,000. So this offer is for $800,000 and it's a 30-day escrow. Escrows can vary from 21 to 30 days. If it's a cash offer, it can be 7 days. Typically, an escrow is 30 days from acceptance of offer till the offer closes escrow, till the transaction closes escrow. So we identify how long the escrow period is. Over here, we identify how much the deposit amount is. The deposit is the earnest money deposit, otherwise known as the EMD, that gets wired to escrow once your offer is accepted. It's usually 2 to 3% of the purchase price, but it can be anywhere from 1 to 3% of the purchase price. That deposit goes towards your down payment and your closing costs, so that when you bring in the remainder of your money, you bring in the remainder of your down payment plus your closing costs minus the deposit. In this scenario right here, this is an $800,000 offer with a 80% loan and a 20% down payment. So this $24,000 right here plus this $136,000 on line F is equal to 20% of 800,000, and this loan amount right here, $640,000, is equal to 80% of that. So 800,000, here's the 24,000, here's the $640,000 loan, here's the remainder of the down payment. This does not factor in closing costs. Closing costs are separately handled. This is just deposit, loan, down payment equals 800,000. Over here, we identify what kind of financing it is. If it's conventional, we don't check anything. If it's FHA or VA, we check these. And then the next section over here talks about timelines and identifying what type of approval the buyer has. So if we were to ask for any seller credit, and this is an upfront seller credit, not a repairs credit. For example, if you wanted to offer a certain amount and then have the seller credit you some money so you can buy down your rate, that's an option, depending on what's on the table, depending on if that's a competitive offer. This is where you would say, hey, we're offering this money, but we would like X amount of seller credit towards XYZ. This is separate from the inspections. If we do a home inspection and there's a lot of things wrong and you want to ask for a seller credit towards those repairs, that's handled later on in escrow through the request for repair. Over here, if we have an all cash offer, we have to submit proof of the cash. If we have a down payment, which we would, we have to submit proof of the down payment. Usually a screenshot of the bank account that has the money in it is sufficient. Verification of loan application. This is the pre-approval letter. We have to submit that with the offer, and we also identify here whether the buyer is pre-qualified, pre-approved, or fully underwritten. I have another informational video that talks about the differences in these. The further along you are in the process for underwriting, the stronger you are as a buyer. Final verification. This is the walkthrough. Every buyer has an opportunity to do a walkthrough of their home prior to close of escrow. This is saying that can happen 5 days before close of escrow. If the seller's made repairs, it's a perfect time to go through and look and make sure that those repairs are satisfactory. Even if a seller hasn't made repairs, it's a good time to go through, take measurements, see the home again, make sure that it's in relatively the same condition as when the offer was accepted, meaning no new cracked windows, no big holes in the wall, nothing damaged, all of that. So you do have an opportunity to do that walkthrough. Even if you don't do the walkthrough, sometimes people say, forget it, I don't have time, they didn't make any repairs, it's just a formality, I don't want to do it. The seller is still required to keep the home in the same condition as when it was, when they first accepted the offer, and I'll show you that later on in this. Loans. So these contingency periods right here, section L through L8 are the time periods in which we are required to remove contingencies. Your contingencies are the safeguards that keep your deposit safe. Loan contingency. This is saying that within 17 days of acceptance of the offer, you will have your loan approval. Whenever you get your loan approval from your lender, it is a conditional loan approval, meaning the underwriter has come back and said, okay, we have the loan approval with XYZ conditions. Sometimes those conditions are minor, like getting an additional pay stub or a verification of employment. Sometimes those conditions are more major, like, oh, they need to pay off this vehicle off of their credit report, so it's not showing up anymore. That's a larger condition that your lender should talk you through even prior to making the offer, or you know what is expected of you once you're in escrow in order to get this loan approval. So whenever you get your loan approval, even if it's conditional, you are to remove your loan contingency. And removing your loan contingency says, I'm ready to move forward. I cannot back out based off of not getting my loan, because at this point you have your approval. Appraisal. The appraisal contingency says that the property must appraise for the agreed upon price. The appraisal is a buyer cost, and it's a report that must be done for the lender to ensure that the property is at least worth what the buyer is purchasing it for, since it's the collateral for the loan. Excuse me. Many times appraisals will come in at whatever the purchase price is, because the appraiser The appraiser's job is to ensure that it's fair market value. And they have a copy of the contract, and they have a copy of comparable sales, and they get a copy of any features, upgrades, etc. And their job is to look at it and say, okay, yes, this is worth this value. So a lot of times buyers are surprised. They say, oh, I paid $673 for this home. That's funny. The appraisal came in right at that number. That's because appraisers will generally bring it in right at the purchase price if they feel it's at least worth that price. If the appraisal comes in low and you have not waived your appraisal contingency, it does not mean that the seller must reduce the price. It means that the buyer has a right to negotiate, and if the seller and buyer cannot come to an agreement based off of a low appraisal and revised purchase price, then the buyer has the right to walk and keep their deposit. A seller is never, ever, ever required to reduce price or make repairs. The cure is always cancellation. If a buyer is not happy with something, provided they have not released that contingency applicable to whatever item it is they're unhappy with or dissatisfied with, the cure is cancellation. They can back out and keep their deposit. So a lot of times buyers ask, well, who's the appraiser? We don't know. It's very arm's length. The lender orders the appraisal from an appraisal management company who then dispatches an appraisal. It's very much arm's length third party, so it can't be influenced. Next contingency, investigation of property. So this right here is the physical inspection. When you do a physical inspection, if it's a house, the inspector will go on the roof, under the house if it has a crawl space, look at all the systems, plumbing, electrical, gas, all of that, and give you an idea if there's anything that would indicate that there's any problems. If you're purchasing a house, I highly recommend getting a sewer scope too. That is where a plumbing company comes in and puts a camera down the sewer line, kind of like a colonoscopy for the sewer line, to see if there's any branches in the sewer line, if there's any big cracks, if there's any misalignment that could cause problems down the line. If you're buying a condo, you don't need to do any of that. You just need a physical inspection for the interior because you're only responsible for anything from the walls in. The inspector will still look at electrical, plumbing, all of that, but it's not as extensive as if you're buying a single family home. Once again, with the inspection, if there are things that come up in the inspection that are concerns, we have a right to ask for repairs or negotiate a credit towards repairs. The seller is never required to make any of those repairs unless they are the minimum mandatory government requirements, which I'll get to later. If a buyer is unhappy with the seller's response and they have not lifted their inspection contingency yet, the buyer can walk, cancel escrow, and their deposit is refundable as long as they have not released the inspection contingency. So that's the physical inspection part. That being said, per the contract, and I'll show this to you later, every home is sold as is in its present physical condition as of the date of acceptance of the offer, subject to buyer's investigation rights. That means a seller is never required to make repairs, but a buyer can come in, do their investigation, and back out if they're not happy with the condition or cannot come to terms on a repair request. Okay, these are some other parts of this investigation period. Review of seller documents. The seller will fill out many, many documents to disclose past fixes, current problems with the house, any issues they've ever had. We have a right to review those, and those are all a part of your investigation period. Preliminary title report, which is right here. The title report is the chain of title, and it shows whether the home has any funky liens on it, if there's anything on there that should be of concern. We look through that. This is what your title insurance is for example. If the seller has a tax lien because they haven't paid their income taxes, and the title report shows this, that title must be free and clear for it to transfer to you. Your title insurance, if it comes into play if there's anything that maybe didn't show up on the title report and it closes escrow, and then all of a sudden you have someone else's lien on your home. Your title insurance takes care of that. That's what that's for. So we have an opportunity to review the preliminary title report as part of our investigation. Common interest disclosures. These are HOA docs. Whenever you're buying a condo, you have, as a buyer, you have the opportunity to read the rules, the regulations, the bylaws, the CC&Rs, the meeting minutes, the budget, everything. the seller is required to have the HOA send you all of these items for us to review. And if there's anything in that that makes you uncomfortable or you're not happy with, you have a right to back out based off of your common interest disclosure contingency. If you're getting a loan on a condo, the seller also has to look at some of the HOA docs to make sure that the association is in good standing and solvent, because when they are approving the loan, not only are they approving you as a buyer, they're also approving the property. Sorry. A lender will sometimes reject a property if there's litigation, if the financials are a mess. There's certain things that would be red flags to a lender because they need to make sure the property is going to remain a good asset, because that's the collateral for the loan that you're taking out. Excuse me. Review of leased or liened items. This is getting a little bit more common. If a seller has leased solar panels or something like that, you have an opportunity to review the lease, all of that. And then if you were buying a property, but you had to sell your property in order to buy it, this would be checked right here. Okay, so those are all the contingencies. Now, it's very common to reduce the contingency periods. Most sellers want to see an inspection contingency between 7 and 10 days, an appraisal contingency between 10 to 14 days, and a loan contingency released anywhere between 14 to 17 days. If we agree to shorter contingency periods and we are unable to release that contingency, for example, say we don't have all the HOA docs, or say the seller hasn't provided all the disclosures, or the loan approval isn't complete yet, but we need a little bit more time. Those contingencies don't automatically lift. We don't get to that time frame and they lift. You have to sign a form called a contingency release form, which you would only do with me in writing once that contingency has been satisfied. If we get beyond our contingency period and haven't released it, the seller could send what's called a notice to perform. That is a threat, so to speak, from the seller to the buyer that says, hey buyer, you need to take this contractually obligated action within 48 hours of issuance of the notice to perform, or I, the seller, reserve the right to cancel. Now the operative word here is reserve. The seller doesn't necessarily mean they'll cancel. It could just be a threat. But if they are getting ready to cancel on us because we're not performing, and performing means releasing our contingencies in the specified timeframes, then the cure is cancellation. If a seller cancels on you for not performing, your deposit is also refundable to you. So shortened time periods are standard, and we just talked about that. Let's get down to possession. So per the contract, unless otherwise agreed upon in writing, you get keys upon notice of the deed recording. Sometimes if there's a seller in possession, then there's a seller in possession form. That's what SIP here stands for. That's filled out. This is all negotiated when we're writing the offer or going back and forth on counters. So it'll never be a surprise like we close and the seller needs more time in the home. This is all negotiated up front. And a lot of times buyers are nervous. Oh, the seller needs 5 days in the house after close of escrow. What if they don't move out? Well, if a seller has 2 days after closing, 5 days after closing, 50 days after closing, it's the same as if they didn't move out on the date of close of escrow. It's no different. So there's paperwork in place if they stay after close of escrow, which is handled on a separate form. But if a seller does not move out after close of escrow and all the terms are agreed to, and we get to the date where they're supposed to move out and they still don't move out, it's exactly as if they didn't move out on the date of close of escrow if there were no agreements to have them stay in place longer. So we can cross that bridge if the seller's asking for a few days. It's pretty common for sellers to ask for some time after close of escrow, especially if they're looking for a new house, but we can cross that bridge when we get to it. Okay. Here we go. Seller delivery of documents, time to pay fees for ordering HOA documents. So these are all of the timelines that the seller has to perform by. So the seller must deliver all of their disclosures to us within 7 days after acceptance of the offer. Return their escrow instructions, which are the forms the escrow sends them within 5 days of the offer. They have to order HOA docs within 3 days of acceptance of the offer. All of this stuff has to happen along a timeline, and these are outlining those timelines that the seller has to do these things. This section right here talks about items included and excluded. So generally speaking, stoves almost always stay. Refrigerators, washer dryers are considered personal property, and those are negotiated on a case-by-case basis. Sometimes sellers want to leave them, sometimes they don't, sometimes buyers ask the sellers to leave them and they negotiate. So this is where we check everything that stays with the property. A good rule of thumb is anything that's affixed to the property, like bolted in, should stay with the property, with the exception of like flat screen TVs. Over here, allocation of costs. This talks about who pays for what. I wrote this very standard. So boilerplate is for the seller to pay for a natural hazard zone disclosure, which is a third-party company generates a report that we review as the buyer and tells us whether the home is in a flood zone, fire zone, earthquake, fault zone, etc. If you're buying a home, it's useful because it'll tell you if you need to buy additional flood insurance, things like that. If you're buying a condo, it's more informational than anything because the building insurance is covered by the HOA dues. When you buy a condo, you only insure the interior and the contents. That's called either a walls in or a HO6 policy. It's two names for the same thing. It's very similar to a renter's policy. Your lender will want you to get that. If you're buying a house, your homeowner's insurance is all you really need. If you get a natural hazard zone disclosure and you are in a flood hazard area, you may need to get additional flood insurance, but I'll help you look over this once we get that report. This is one of the reports that we read from escrow. We ask for the seller to pay for that report. Home inspection. Home inspection is always the buyer's cost. The buyer pays for the home inspection. The buyer chooses who the home inspector is. In this case, we ask for a termite report paid for by the seller. If you're buying a condo, you don't need to ask for a termite report because the termite is handled by the HOA. They have their own schedule for when they inspect it, when they do work, all of that. You're not responsible 99.9% of the time for any termite work if you're living in a condo. If there's termite work inside, like say you have a wooden windowsill and you have some termite damage, it's kind of a gray area. We could go over that case by case, but 99% of the time, you do not need to worry about asking for termite work to be done or a termite report when you're buying a condo. When you're buying a single family home, it is standard to get a termite report. In this case, we've asked the seller for it. Sometimes the seller will say, I'm not paying for a termite report. Buyer, you do that as part of your investigation. A termite report costs $75. A termite company will come out, look at it, issue a report, and tell you how much it's going to cost to do the termite work, which at that point, we can see if that's a negotiation we want to have with the seller on the request for repairs or credit for repairs. Okay, here we go. Section Q5, government required point of sale requirements. Per California law, a property must only have 3 things in most cities to sell. Smoke detectors in each bedroom. If the water heater is a tanked water heater, it must be earthquake strapped. And there must be a carbon monoxide detector in the house. Beyond that, if a property is falling off its foundation or doesn't have a roof, and the lender and the buyer and the seller are all in agreement about the condition and the sale's going to happen, only those 3 things must happen. Smoke detector, water heater, straps, and carbon monoxide detector. Now, some cities have point of sale requirements. City of Carson, the city will come out, do a health and safety report, and the seller has to fix some things. City of San Pedro, the city will come out, make sure that the gas meter has an earthquake disabler on it. They also look at the toilets, I believe. They have to be low flow. So certain cities have different things. If you're buying in a city that has these point of sale requirements, we ask the seller to take care of those things. Most cities don't have those point of sale requirements, but any government requirements or city point of sale requirements, we're asking the seller to do those things. Now, escrow fees. Escrow is a third-party company that facilitates the transaction between buyer and seller. Some states have attorneys. We have escrow. Escrow is usually seller's choice who the escrow company is, and each to pay their own fees. There's escrow fees for the seller. There's escrow fees for the buyer. Owner's title insurance policy. The owner's title insurance policy is paid for by the seller. The title insurance provider is seller's choice usually. The buyer's lender's title insurance policy, which is the buyer's insurance policy, is paid for by the buyer. The title insurance, again, protects the title from any funky liens on it that may show up, as I talked about earlier in this presentation. So each to pay their own title insurance. We ask for the county transfer fees to be paid for by the seller. If there are city transfer fees, the seller to pay for those. Some cities don't have them. Long Beach doesn't have a city transfer fee, but some cities do. If there is a transfer fee, then we're asking for the seller to pay for those. HOA fee for preparing disclosures. Whenever you buy a condo, as I mentioned before, you have an opportunity to read all of the HOA documents, the budget, the bylaws, the rules, the regulations, the meeting minutes. The HOA charges money to produce those items. The seller is responsible for paying that fee. The fee can be $200. I've seen it up to $1,400. The seller pays for that once we open escrow. They send the documents to escrow, and then we receive the documents to look through. The HOA certification fee is a different fee. If you're getting a loan and you're buying a condo or within an association, the lender will require an HOA cert, which is a brief questionnaire that the HOA management company fills out and says whether the HOA has litigation, how many renters there are, how many owners there are, whether more than 10% is owned by one entity, and all of these things help the lender establish whether the HOA is lendable, whether they can lend money on this particular condo. This is one of the ways that the lender ensures that the property, the collateral for the loan, is solvent and in good standing. Excuse me. Okay. Those HOA fees, the HOA cert fee, anywhere from $100 to $200. That's a buyer responsibility. That's also not a pocket cost. HOA transfer fee, the seller to pay for the transfer fee. This is different than the doc fee. The HOA charges money to transfer the name into the buyer's name. Private transfer fees. In 20 plus years of real estate, I've never dealt with a private transfer fee. I've never seen one, so I just leave that unchecked. The last thing we're going to ask for here is a home warranty plan paid for by the seller. A home warranty plan is different than your homeowner's insurance. It's a 1-year home warranty plan that you choose who the provider is. I have a couple of great providers. I can provide information on what their coverage entails. And the home warranty plan covers most of your systems and appliances in the home for 1 year up to the coverage limits. So let's say you move in and your oven breaks. If you have a home warranty in place, you file a claim with your home warranty company. They will dispatch a technician from one of their vendors to come out, look at the problem, fix it up to the coverage limits. If they can't fix it, they'll replace it up to the coverage limits. When you have a home warranty, there is a service call. It's usually between $65 to $85, depending on the home warranty provider you chose. And that is your total cost, as long as whatever you're getting fixed is covered by the home warranty. So it's normal to ask for a seller to pay for a 1-year home warranty. After that home warranty is up, you have the opportunity to renew it if you want. I think it's a good idea to have it. It's just an extra added protection. A home warranty, like things that you could use for a home warranty claim, is say you need a plumber because your toilet backed up. Some home warranties even cover key changes. When you get your new house and you get your keys, for the service call of $65 to $85, they'll come out and rekey all of your keys, which is cheaper than a locksmith coming out. If your microwave breaks, if your oven breaks, if your dishwasher's covered in the home warranty, if your refrigerator's covered in the home warranty and that's not working, your washer, dryer, all of these things. So with this, we say what kind of coverage we want. We want the updated home warranty with appliance and HVAC coverage. That's assuming the home has HVAC, which is heating and air conditioning system. Buyer's choice of who that home warranty is. We can help you decide who to choose. Okay, now the rest of this is going to go pretty quickly because this is mostly informational. This next page talks about all of the addendums that are with this offer. There's a few that are baked in right here, the buyer's inspection advisory. We'll go through that next. It's after the offer. The wire fraud advisory we already went through. The fair housing advisory we already went through. That was in front of the offer. And the Privacy Act notice is subsequent, so we'll go over that next. So these are baked in. They're always a part of the offer. We don't have any of these others checked on this sample because in this case, we don't have a septic system or a short sale addendum. If we do, I can explain what all of those are, but we're not subject to those addendums with this offer. Okay. These are definitions of things. A lot of this I've already covered. Definitions of things, all informational. Here we go. Seller remaining in possession after close of escrow, like I said. If that's agreed to, it's all in writing, it's all documented. Contingencies and removal of contingencies. So here it talks about the different contingencies. I've covered this in this video and also in the buyer's booklet. Here's the appraisal. We talked about that. If you waive your appraisal contingency, which some buyers do, all that means is that if the appraisal does not come in at the sales price, then you have given up your opportunity to back out and keep your deposit. You must proceed on purchasing the property at the sales price. It doesn't mean that your inspection contingency is waived. It doesn't mean that your loan contingency is waived. It just means that if you waive your appraisal contingency, you have removed your right to back out based off of a low appraisal. Investigation of property. Okay, there is something very important that I would like to point out on this. This talks about the inspection, which we talked about. This is all informational. Planned development disclosures, those are the HOA docs. We've talked about all of this. This is all informational. This right here talks about anything included. Anything affixed to the property is included. Any personal property is not included. Flat screen TVs, things like that are not included. Here's the legally required things that are included, the carbon monoxide, the smoke detectors. We talked about all of this. This is all informational talking about when the seller needs to provide certain things, which we talked about in the first couple of pages. Ooh, let's see. All informational. Okay, let's talk about this. Time periods, removal of contingencies, and cancellation rights. The time periods are all specified in the offer under the section where all the contingencies are listed. If a buyer doesn't remove their contingencies in time, the seller can try to cancel on them. If a buyer cancels and does not remove all of their contingencies, their deposit is refundable. However, because the deposit is held in escrow, which is a neutral third-party company, nothing can happen without agreement from both parties. So if the buyer cancels, the seller has to agree to the cancellation and sign, and in that form is instruction on what happens with the deposit. It is possible that a seller could be difficult and not sign the cancellation and agreed to give the buyer's deposit back. That does not mean your deposit is lost. It means a couple of things. One, you would potentially go to arbitration. Two, unless the escrow gets canceled, the seller cannot resell the property. So in most cases, sellers are very eager to just move on, get the property into escrow again, sign the cancellation, and the buyer gets their deposit back from escrow, in most cases. In the event that there is a disagreement about the deposit, which is usually the reason why buyers and sellers are fighting, we have a couple of options. There's arbitration or litigation, and we'll get to that in a subsequent section because I want to point something out. So those are the seller's rights to cancel. The buyer's rights to cancel are until they've removed all their contingencies. And if a buyer removes all contingencies, they can still cancel, but they may be subject to losing their deposit once they've removed all contingencies. Okay, here we go. Okay, so this is very, very important. A seller is never required to make any repairs. A buyer has a right to inspect the home, ask for repairs or credits, but if seller and buyer cannot come to an agreement, the buyer has a right to cancel based off of their inspection contingency. Many times we might see a seller say, hey, the property is as is. If you accept an offer or a counteroffer that says the property is as is, that does not mean you are required to buy the property in its condition. It means that the seller is not going to make repairs or credits and you have the right to back out if you find things that make you not want to move forward with the property. So right over here, unless otherwise agreed, the property shall be delivered as is in its present physical condition as of the date of acceptance. The property, including pool, spa, landscaping, and all grounds, is to be maintained in substantially the same condition as of the date of acceptance, and debris and personal property not included in the sale shall be removed by close of escrow or at the time possession is delivered to buyer, if not on the same date. So, in the contract, it's already stipulated that the property is as is, unless otherwise agreed. That's the caveat. That's where unless otherwise agreed means they've made a repair request and the seller has agreed to it, or a credit request and the seller's agreed to it, and that's all done with paperwork, so everything is completely documented and covered. But a lot of times buyers get nervous if a seller comes back with a counteroffer and said, hey, this property is being sold as is. It does not mean that the seller is hiding anything. It does not mean that the seller knows something is wrong with the property, and it never means that the buyer must purchase the property in that condition. It just means that the seller is reiterating what's already in the contract and is not going to make repairs or credits. If a buyer does their inspection and is unhappy with the condition and does not want to move forward with the purchase, they can back out and keep their deposit based off of their inspection contingency. Okay, so everything else here is informational. Everything else here is informational, definitions of things we've already talked about, informational, definitions. There are a couple of important things coming up here. Definitions. Okay, right here. Clause 29, liquidated damages. This says that if the buyer gets into escrow, goes through the escrow process, releases all of their contingencies, which you would only do with me in writing once that contingency has been satisfied. If you release all of your contingencies and then try to back out at the 11th hour, the seller can try to keep your deposit as liquidated damages. Now, if buyer and seller do not agree upon cancellation, and usually they're disagreeing about a deposit, then the solution is arbitration. With the arbitration clause, it says that if things get so ugly between you and a seller that you're threatening to sue each other, you agree first to do arbitration. If you do arbitration, it's done in front of the real estate board, and the real estate board understands the contract inside and out and understands what your rights are and your contingencies are as a buyer. I think it's in most buyers' best interest to agree to arbitration. It's faster, it's less expensive, and the people who are deciding the fate of usually the deposit are people who completely understand the contract inside and out and how it protects the buyer. Now, you are not required to sign this, the arbitration clause, when you make an offer, but a seller could say, unless they sign the offer, I'm not accepting the offer. Unless they sign arbitration, I'm not accepting the offer. So 99% of people do sign it. Sometimes every once in a while someone doesn't want to sign it. Usually it's an attorney because they want to go to litigation instead of arbitration. But it's up to you whether you want to sign it. But just keep in mind, a seller could say, I'm not accepting this offer unless they sign it. Okay, so that's it. That's the meat and potatoes of the offer. This last page is the signature page. If the seller counters us, they would check this right here where it says seller counteroffer. A counteroffer means, hey, we accept your offer subject to the counteroffer that we are sending you. So if a seller counters on any terms, the counteroffer terms supersede the offer terms. If they just accept it straight out, they just sign it. Over here, my signature, the other agent's signature if they do accept it. Now, the offer expires technically 72 hours after writing the offer. However, that does not mean that if the seller gets back to you 4 days after we've submitted the offer and wants to accept your offer, that it's void and we have to write a new offer. It just means that if you make an offer on a Sunday, and then you make an offer on a Wednesday, and then you make an offer on a Saturday, and Sunday seller gets back to you and accepts your offer, and Wednesday seller gets back to you and accepts your offer, and Saturday seller gets back to you and accepts your offer, you're not technically bound to 3 properties. That being said, If a seller accepts your offer and you don't want to move forward, it's very easy. We just send in a cancellation or a withdrawal of offer if they haven't accepted it, or a cancellation if they have. So that's no big deal. It's just paperwork. If it's early on before the deposit has been sent in. The next page after this is the buyer's investigation advisory. If you recall, there was a section of addendums that were baked into the contract, and this is one of them. This is just a generic addendum saying, hey buyer, it's your right and your duty to do your due diligence, get a home inspection, read the disclosures from the seller, read the reports from escrow, really satisfy yourself that this is the property you want to move forward with. And then there's definitions of things. This is the Consumer Act, Privacy Act notice, and this just says, hey, no one's selling your information. It's just intended to make sure that they have the correct people on file and your information is safe. So that's it. That's the entire purchase agreement. I know this was long. You've been very patient going through this, but it's a lot of paperwork, and when it does come time to sign an offer, I want you to be fully comfortable with the paperwork and understand what you're signing. If you have questions on any of this, please reach out. Thank you.